This is Mark Anthony with Mercury Time Price Analytics. Welcome to our end of day video update for Wednesday, August 5th. Didn't have a chance to do an end of day wrap video. Well, not a not a musical wrap video, an end of day wrap up video. My wife was trying to contain her giggling here. Didn't have a chance to do a end of day video yesterday. And it's just as well because relative to yesterday, today was Groundhog's Day. It was the same thing. Algorithmically, same thing. Now, what we get tonight and tomorrow, we'll have to see. But and we're going to swing back around to this chart in just a minute. So, chart number one, S&P 500. Yesterday, Tuesday the 4th. Now, one of the things that you should put on your chart as soon as the day session opens at 9:30 Eastern time is the opening print, the opening tick at 9:30. And there's nothing complicated about it. There's nothing algorithmic about it, but it's important to always monitor how the price action trades relative to where the day session opened. Because as you've all figured out by now, you get a lot of nonsense, a lot of movement in Globex in the evening and in the European session in the morning that oftentimes has nothing to do with characteristics of the tape during the US day session. So this is the end of day chart from yesterday for the S&P 500. This is Monday's opening print, 3283. Tuesday's opening print, 3278. Now, first question. In a strong tape, should Tuesday's opening print be lower than Monday's? Now, in and of itself, that's anecdotal, but when you start putting all these different things together, you see a tape that is very extended, very tired, and very sloppy, okay? Now, the early high, late 10 o'clock window, right before 11 o'clock Eastern time. You come up here to 32.95, and you know everybody's watching the roundy at 3,300 because that's what traders do. All right, you get close to a roundy, it seems like a foregone conclusion. Here's the problem though. Before 11 o'clock, you hit a high of 32.95. It took over 4 hours to eke out those last 5 handles. Now, what's more important is this action at the end of the day. You see this little move started just after 2 o'clock. Now, why is that important? Because there's some very important algorithmic time cycles that institutions trade off of that roll over just after 2 o'clock. There's a couple of them. And that's when this got started. When you see the tape start to move a little bit after 2 o'clock, that's the institutions. What this was here, we'll talk about that in a minute. But just after 2 o'clock, you get this move down. You go through Monday's opening print at 32.83. You go through Tuesday's bull bear pivot, which was right at the same price, just under 32.83. And after taking out Monday's opening print, you come down here within a couple handles of Tuesday's opening print. Now, here's the question. In a strong tape, should you be testing the opening print at 2:30 in the afternoon? No. We see this pattern over and over again at every intermediate high, every long-term high, every significant reversal. When the bull market gets tired and it needs a correction, you see this same behavior where it'll go a couple of days and it'll struggle just to finish the day above the opening print. But you should not be testing the opening print at 2:30 in the afternoon. And then sprinkle some magic dust on it and you get this. Boom. Now, let's take a look at NQ for yesterday. What chart is that? Chart 4. Here's NQ. Yesterday, end of day screenshot. And Monday's opening print, it's the same pattern. Monday's opening print in NQ futures, 10,987. Tuesday's opening print, Let's see. Tuesday's opening print is 11,015. So Tuesday's print was just a little bit higher than Monday's. But it's the same thing. Late in the day, you come right back down to test the opening print. You shouldn't be doing that at 2:30. Okay, again, they sprinkle some magic dust on and boom, ram the thing up into the close. Now, let's look at today. Again, Groundhog's Day. What chart is that? Thank you, chart 5. All right, here's the S&P 500 end of day screenshot for today. Opening print today, 33.14 1/4. You get the same late day move. Now, today it was even later. You got a move down that traded below the opening print really late in the day. It was, what time was it? 2:43 in the afternoon. You shouldn't be testing that. Now, forgive me, that wasn't 2:43. Get it together, Mark. This was after 3:30, very late in the day. You're coming down here, breaking the opening print, and it came. This is the other thing that's interesting. Where did they give you the stick save? Literally to the tick at the midday algo pivot. Now, this midday algo pivot right here is generated. It's a time cycle. It's generated between 12 and 12:30. Now notice the tape wasn't trading here between 12 and 12:30. We don't look at the chart and say, well, that's a good spot for a support line or a resistance line. Everything that you see on our charts always is mathematical algorithms. The only exception is this opening print. Okay? Any horizontal lines you see on the charts, any of those oscillators, those are all a mathematical formula. So it doesn't matter where it was trading at the time we put out the midday pivot. It's a mathematical equation based on time and price, because that's what the institutional algos work on. They work off of time. You hear me say this all the time. Time is more important than price. Time is more important than price. You can't build an algorithm anchored to price. Why? Because hypothetically, price starts at 0 and goes to infinity. You can't build anything repeatable on something that's linear from 0 to infinity. Well, look at a clock. It's the same number of trading hours, minutes, and seconds in every day. So they have multiple time cycles that they anchor price to, and you A, have to know exactly what the time cycles are, B, you have to know exactly what time to run the data, and then even more importantly, there's certain times a day where multiple time cycles line up, and that's where you get the really big inflection points. And I'm going to talk about the daily bull bear pivot because this is interesting too. I'm going to come back to the concept of the daily bull bear pivot in just a minute. Remind me in just a minute. Not you. I can't hear you, of course. Chart. What is the next one? NQ chart 6. Here is NQ for today. Now again, Groundhog's Day. Opening print today, 11,101. It closed right on the opening print. I mean, right on the opening print, right on the daily bull bear pivot, no extension whatsoever. Like I said earlier, this tape is extended, tired, and sloppy. Okay? ETS, kind of like ETF. Extended, tired, and sloppy. Like I get some late Sunday afternoons in football season. I'm just kidding. I don't drink, don't do drugs. My wife can barely stand normally. All right. But this is the same thing. You traded over and above the opening print all day long. A bullish tape doesn't do that. This tape needs a rest. It needs a healthy correction. Now, a couple of levels, if you're an NQ trader, a couple of levels to watch on Thursday and into the end of the week. This Mercury band at 1144, you can see all the behavior that's gone up and down, above and below 1144. And by the way, these Mercury bands on ES, we recalculate the Mercury bands every night after we get the full close at 5 o'clock, not the 4 o'clock, not the 4:15. We have to wait until the full close at 5 o'clock Eastern time. But the Mercury bands on ES, those are recalculated every evening prior to the Globex open at 6 o'clock. The NQ Mercury bands are only calculated once a week on the weekend. I run them on Sunday before the market opens. The only time we recalculate the NQ Mercury bands is when price in NQ trades up into the very upper end or down into the very lower end, and then we update them. But this goes to show you the mathematical immutability of these cycles, that we run these things on the weekend and they are pivotable. There's a new word, adding syllables. Pivotable, I suppose, is more important than pivotal. Make a note of that. But keep an eye on 11,044 if you trade NQ. And even if you don't trade NQ, you have to watch NQ if you're trading the S&P 500, right? So keep an eye on 11,044, pardon me. And then keep an eye on this little beauty. XSV3 algo pivot. That is one of the most powerful algos because it combines a lot of different time cycles, and it combines them over a very, very long look back period, months and months and months. I put this on the chart and posted on Twitter on July 13th as price was trading now about 30, 40 handles below it. And I mentioned that this was going to be a pivotal spot. And if we roll this chart, this is a screenshot, so I can't roll this back. But on that very night, it went up above and crashed down below. All right. So since that time, when it went up above, and then you had this deep pullback. This deep pullback was right after you had that, what I call an algo hook, where price ran the stops above and then they took it right back down. But just here, this was just yesterday, it's come into this level and tested it 3 times, actually 4 times counting this one. Now, one of the interesting things about algorithms, and there's actually a reason for this, but due to time constraints, it's beyond the scope of this video. When you test an algorithmic level the 5th time, price goes through. If you're testing an algorithmic support price 5th time, 1, 2, 3, 4, it will typically break and break hard. When you're going up and testing an algorithmic resistance line 1, 2, 3, 4 times, back off, gather a little steam, boom. 5th time tends to get very, very violent. Keep that in mind. 11,044 and 10,983. 5th time in algorithm is not a charm. Well, unless you're already positioned in the direction it's going. Keep that in mind. Now, I don't want to spend a lot of time on this chart. This is just a very fast set of oscillators. This is yesterday. The point I wanted to make is that yesterday you come down. These orange ones are key trend levels. Now, the horizontal lines that you see on our charts, like this, these are a second derivative of our algorithmic oscillators. So all we're doing is we're looking at the algorithmic oscillators at particular points in time, and then just the algorithm just takes that price point and gives us these vertical lines. So these are a second derivative of these oscillators. And what's cool about these oscillators, you can take any time cycle, short term, intermediate term, long term, and what we look for is areas where you see recurring peaks or recurring troughs or spots where price crosses over. And I'll just give you one example. Take right here. You have a peak, this peak, this peak. You can take a line from right here and take from and focus on this little sort of inverted U shaped right here. Take a line from the top of that and bring it over. And where did that break hard? Right there. Take that and draw it over. It's right at what price is that? 30, right at 32. 90, 32, 89. Take it over here. It recovered it, broke it again, recovered it, broke it again. Now, another thing that you can do is you take prices at which algorithmic time price oscillators of differing lengths, differing time periods, and note the points where they cross over. So here you had this little crossover, call it, say 88-ish. Take that over here again. Same thing. Important. Right here. Take that one across. From there to there. Take this one across. It came up here, paused, and right there, boom. And this level was important because you have the fastest one, this purple one, crossing up through both of these longer cycles. And so right in this area, right in this price, you break it and you recover it, and it's like a slingshot. Boom. And there's a lot of different things you can do, but one of the dynamics of time and price, another reason why time is more important than price is time. You ever heard the expression space-time? You know, space-time is what derives the gravitational pull. The space, I don't want to get too deep in this. Maybe we'll do something on this weekend. But that's what creates the gravitational pull of the sun, which determines the orbit around the sun of the rest of the planets. And what I mean by that is this. Time is a magnet for price. Price continually gets pulled back by the if I said gravity is not the right term, magnetism. Price gets pulled back by the magnetism of time. These regression lines, I posted a tweet about this tonight. These regression lines are so important because these are the absolute center of magnetism for time and price. Price comes back to these constantly, and it'll fight over them for a while, then it'll release. Now, this is a real short time frame, and we're going to look at a chart, a longer term time frame of these in just a minute. But I'm getting off the subject, so let's keep it moving, Anthony. What's our next chart? That was chart 2. Next one is chart 3. Okay. Here's the regression lines, another view. Now, these obnoxious blue regression lines, these are a big deal. Because if you break this one, there's a problem. Remember I said a minute ago, you break something 4 times. Algorithmically, the 5th one is a big problem. Lower regression line. And these tan lines, these are regression lines also. But these blue ones, these are the master regression lines. You broke it here once. You broke it twice. You broke the blue line a 3rd time. You broke it a 4th time. Now, this is why markets need corrections. Because what is the angle of the regression line? It's higher. This is just going to continue to march higher linearly, easy for you to say, linearly in time. Ultimately, at some point, this will break. And the next time it breaks, it's likely that it breaks hard. So, and I keep reposting these on Twitter every day, and I talk about these regression lines in every video because these are extraordinarily important. And we're going to look at one more of these in a minute. So, last couple of charts. I think is that all but one of them? 1, 2, 3, 4, 5, 6. Did I show you chart 6? Yeah. Okay, so last chart. This is another view of the regression lines. This is end of day. Was this other one? Was this one a previous day? Yeah, this is end of day Monday. Okay. Now let's look at these at the end of the day today. So Once again, it bounced off this this upper regression line. This is the upper master regression line. This is the lower master regression line. This is the one that got broken 4 times. So now you're really getting up here into rarefied air. But this thing needs, it needs a rest. And my suspicion is the next time you break this regression line, you're going to make a beeline for this one, and that better hold. Because there, look, there is some nastiness coming. I'll include this this link at the description of the video. If you go on our website, mercurysignals.com, and at the top, one of the menu items says it's either market reports or weekly reports. I don't do them every week. Either says market reports or weekly reports. Click on that. That gives you the archives of all of them going back to the first of the year. And you want to go down and click the one that says this does not compute from February 22nd of this year. It'll take you 5 minutes to read it. It will be the best 5 minutes of technical analysis that you'll spend in a long time. I'm not saying, let me clarify that. That didn't sound right. I'm not saying it is the best piece of technical analysis. I'm saying it will be a very valuable use of 5 minutes of your time to put in perspective what we're seeing now, because I'm sharing with you, gang, that what we're seeing right now is just a carbon copy of what we saw in February. Remember in February when price finally got over 33.52, that was a big hurdle. And then it went a little bit over 33.60. What happened after that? Had a little pullback, and it came back up to that 33, it was low 33.60s. And after it made a new high, what did it do? Nothing. Went a handle or two above, and then it reversed. Why? Because there were no stops up there for the algos to consume. When algos probe the upper end of the range and the lower end, and when they don't find stops to consume, like little Pac-Man or Ms. Pac-Man, if they don't find stops to continue to consume, they take it back the other way, and they start probing the other direction. And so you had a little test above the low 33.60s. Then after that, you went up to the high 33.60s. You had a pullback, and what happened again? Went a little bit above that spot, high 33.60s, made a marginal new high, no extension. And it kept doing that over and over again. It did it then after that in the low 33.70s, and in the high 33.70s, and in the low 33.80s, and the high 33.80s. Now, how did we trade that? We traded it the same way we're trading it now. We're selling every rip. Now, you have to quickly take incremental profits, and you have to keep your stops on a tight leash. You have to get risk out of the trade as quick as possible. But we're trading it the same way we did back then. And, you know, there were 2 weeks, maybe 3 weeks there, where we booked over 300 handles 1 week, over 500. This is ES, not NQ. 300 handles, 400 handles, 500 handles. Because when we saw that the algorithms were not finding additional stops to consume, you know what you're going to get. And we did that all the way up to the high. And that last push up into 33.97, we were short. It was either 33.92 or 33.93. It's all in that article. February 22nd article. Scroll down to the bottom of the weekly report archive on our website. And it's called This Does Not Compute. For those of you that are my age or older, you might remember a TV show in the late 60s called Lost in Space. Remember that goofy robot that would flail its arms around? This does not compute. Take 5 minutes and read that article. You're going to see the same thing. And the stuff that I'm hearing from traders now is the same kind of thing also, because everybody is convinced that the long thesis is immutable. Here's the problem. One of the reasons that institutions in large part now use computerized machine learning algorithms is because they have no emotion. And when the majority of traders become of the notion that the long thesis is immutable. That is exactly when they'll pull the plug, because they don't care whether they don't care about sentiment. I mean, some of them are built on sentiment, but most of the algos can care less. They don't care if you're all bulled up. All they care about is there's no stops to consume. And they will keep taking it up and reversing it. But the problem is, every time they make a marginal new high and reverse it, what happens to these regression lines? They get higher and higher, and they become less and less and less sustainable. And if you don't have a healthy correction, as was the case up into that all-time high at 33.97, needed a pullback, traders didn't want to hear it, they kept loading in on the long side, then you get a nasty one of these. Now, if you're asking me whether the next 50 handles are up or down, you know, we'll see how this week ends. I mean, we had a non-farm payroll report on Friday. But this video is being recorded Wednesday evening. Right now, it's just before 9 o'clock Eastern time. I would not be surprised to see a healthy pullback tomorrow. Call it position squaring in front of the NFP report Friday. Call it whatever you want. But one of our key metrics, we call it our X5 pivot. It's a key institutional algo level that comes out at 10 a.m., 30 minutes into each day session. The X5 pivot over the last 5 days has gone up 80 handles. That is completely unsustainable, okay? We're coming into some really key levels up here in the, I mean, right now we're trading 33.26, up into the high 33.20s. And I'll talk about this tomorrow. What started everything was what appeared to be just a normal pullback from 33, 32, 33, 33, 33. January 22nd, you know, like a football coach that remembers specific plays from games years ago. I remember specific setups. There's and you might want to go back and read this report also. The report that ended January 24th, because in that report, you'll see the chart from January 22nd, seemingly innocuous trading day that opened the day session around 33.22, 33.23, traded down to the roundie at 3,300, recovered it. Here's the problem. You had all these algorithmic pivot levels, those horizontal lines, all condensed together within about 20 handles. And so even though from high to low that day was only 30 handles, it found support just a couple handles above 3,300. I mentioned that day, and I wrote about it at the end of the week, that you had significant technical damage that day. And people said to me, well, what do you mean technical damage? I mean, the high to low from open to, you know, from the day session was 30 handles. And it found support just above 3,300. So, you know, no harm, no foul, right? No. What happened 2 days later? It's in that same report, Friday, January 24th, big down day. Big down open on Sunday, the 26th. Much lower. I mean, it was like 100 some odd handles, like 120 handles from Friday the 24th open to Monday's low. I'm telling you, this is just like today was Groundhog's Day relative to yesterday. This whole pattern, this whole, you know, the trading characteristics of this tape are no different than what we saw back then. Please take a minute to read that article. It will keep you out of trouble. It will keep you from getting run over. So let me just close with this. This is not a time to get cavalier with the tape, whether you're long or short. Reduce your position sizes. Take incremental profits in your trades quickly. Move your stop to even as quickly as possible. And do not get stubborn long or short. This is the kind of tape that will run you over if you get stubborn. Lastly, we encourage you to check out our website. If you want to try out our service, use coupon code 40. That's 40. That'll get you a 2-week trial for $88. You'll be blown away. What we provide our customers, not only in terms of quantity of data, but more importantly, the precision. There is nothing outside the institutional algorithms that does what these Mercury systems do, because they are the same math that the big institutions and the big hedge funds are using. It is no different. So I'm going to close there because I could go on another 20 minutes, and we're already 30 minutes into this. Check out our website, mercurysignals.com. If you want to catch me on Twitter, it's at MC2085, MC2085, or shoot me an email at markanthony@mercurysignals.com. Most importantly, I hope everyone in your life is healthy. Take it easy. I mean, better times are coming. We're going to talk about some very important topics in our video tomorrow. But that's going to be a wrap, folks. Thank you so much for your time. God bless you. God bless your family. And I have a feeling we're going to have some fireworks tomorrow. So tune back in tomorrow night for the all-important Thursday, August 6th trading update. Thanks, folks.